Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries behind the money. Today we are diving deep into Public Storage's 2025 annual report, and let me tell you, it's like a treasure hunt for the truly interested investor, full of numbers that tell a story and risks that keep you on your toes. First off, if you love getting clear, no nonsense insights from companies' financial documents, make sure you subscribe to this channel. And hey, we've got a fantastic community over on Discord, linked in the description below, where we break down these reports even further. You should totally join us. So Public Storage, a giant in the self-storage world, is showing us their performance for the year ending the 31st of December 2025. They own a boatload of facilities, over 3,000 of them, with more than 229 million net rentable square feet. That's a lot of space. Let's look at how their self-storage operations performed. Total revenues for their self-storage facilities hit a massive $4.489 billion, which is up about 2.1% from the previous year. That's good, but it is important to see where this growth is coming from. When we zoom in on their Sammy store facilities, which are the ones they've owned and operated stably since early 2023, revenues actually stayed pretty much the same compared to 2024, at about $3.764 billion. This tells us that while they are acquiring and building new places, their core, established business is holding steady. Not really growing in revenue. They did see their rental income per occupied square foot go up slightly by 0.5%, which is nice. But this was offset by a small dip in how full their storage units were, with average occupancy dropping by 0.4%. So they were charging a tiny bit more to the tenants they had, but they had a few fewer tenants. The costs for these same store facilities went up by 1.8%, mostly because of higher property taxes and other operating costs. Property taxes alone jumped 5.3%. So even though revenue stayed flat, their expenses crept up, leading to a slight decrease in net operating income from these stable locations. Now, where is that revenue growth coming from then? It's from those acquired facilities. The revenue from facilities they bought since 2023 shot up by a huge 32.7%, reaching $246 million for 2025. This includes a big jump from facilities acquired in 2025, which contributed $33 million right out of the gate. This part of their business is definitely expanding. But here is the kicker: while revenue from acquired facilities is booming, their net operating income from these newer places is up an even more impressive 34.2%. This suggests they are doing a good job integrating these new properties and making them profitable quickly. Across all their self-storage operations, their total net operating income, which is revenue minus direct and indirect operating costs, was $3.312 billion. That's a 1.6% increase, mostly thanks to the growth in these acquired and newly developed places. Now, let's talk about funds from operations, or FFO for short, which is a big deal for REITs. For 2025, their FFO per common share was $15.81, which is down 8% from $17.19 in 2024. That's a pretty significant drop in profitability for shareholders on this key metric. Interestingly, when you look at core FFO, which strips out things like foreign currency fluctuations, their core profitability actually went up slightly by 1.8%. This is because 2025 had a pretty big foreign currency loss, $215 million, which really dragged down the net income. So their core business is doing okay, but external factors like currency exchange rates are hitting their reported profits hard. Looking at the company's strategy, they are focusing on three main things: improving existing properties, acquiring and building new ones, and growing their other businesses like insurance and third-party management. The numbers show they are certainly active on the acquisition front, spending nearly $945 million in 2025 alone to buy 87 new facilities. But it's not all smooth sailing. Public Storage faces some pretty significant risks. They mention natural disasters, terrorist attacks, and civil unrest as potential disruptors. And operating costs, especially property taxes, could increase. They specifically call out increased property tax in California as a concern. Cybersecurity is also a big focus for them. They've invested a lot in protecting their systems, which makes sense given how much sensitive customer data they handle. They haven't had any material cyber incidents to date, but they acknowledge the risks are always evolving. When it comes to their stock, they've been pretty consistent with dividends, and they have a share repurchase program, though they didn't buy back any shares in 2025. The aggregate market value of their common shares held by non-affiliates was a massive $44.2 billion as of the 30th of June 2025. Let's look at their cash situation. They have about $318 million in cash and equivalents as of the end of 2025. They also have a $1.5 billion credit line, which they weren't using at all. They expect around $605 million in retained operating cash flow for 2026. However, they also have about $1.2 billion in debt payments due in the next year alone. They plan to refinance this, but it highlights the constant need for capital in this business. And the auditors at Ernst & Young LLP have given Public Storage a clean bill of health for their financial statements and internal controls. They did note that determining the fair value of acquired land and buildings involves a lot of management judgment, especially when comparable market data is scarce. That's standard stuff in real estate. But it means there is a degree of estimation involved. So what is the story here? Public Storage is a massive, stable company that's growing primarily through acquisitions rather than organic growth in its core business. While their overall revenues are up, their profitability per S-Hair, measured by FFO, has taken a hit, partly due to external factors like currency fluctuations, but also due to rising operating costs like property taxes. They are actively managing their risk, but rely heavily on their ability to access capital markets for their expansion plans. The leadership changes announced in early 2026, with a new CEO coming in, signal a potential shift or continuation of strategy. Ultimately, Public Storage remains a dominant player in a resilient industry. Their sheer size provides economies of scale, but they'll need to keep a close eye on rising costs and the fluctuating currency markets. Diversifying through acquisitions and other operations helps, but the core self-storage business is showing signs of maturity, not explosive growth. What do you all think about Public Storage's 2025 performance? Are they a solid investment, or are the risks outweighing the rewards? Let me know your thoughts in the comments below. And if you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate deep dives. Don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and I'll see you in the next video.